Borrowing money from your own corporation can be a tax-free way to access funds beyond your normal salary or dividends. But there are strict rules you need to follow to avoid unexpected tax consequences. A shareholder loan allows you to borrow money from your company, but the IRS has specific guidelines to prevent these loans from being classified as taxable income. The fundamental rule is that these loans must be legitimate financial transactions, not disguised compensation. When you borrow from your corporation, you must record the amount in your books as a shareholder loan. This loan typically needs to be repaid within 1 year of your corporation's fiscal year end. For example, if you borrowed $10,000 in 2012 and your company's year ended on December 31st, you would have until December 31st, 2013 to repay it. If you fail to repay within this time frame, the borrowed amount gets added to your personal taxable income for the original tax year. It's important to understand the difference between a shareholder loan and other forms of payment. A shareholder loan is a temporary borrowing that must be repaid with interest and properly documented. This differs from salary or bonuses, which are taxable income subject to payroll taxes, and dividend distributions, which are taxable payments from company profits to shareholders. To ensure your withdrawal is treated as a loan rather than compensation, you need to sign a formal loan agreement with a repayment schedule, pay interest at or above the applicable federal rate, and record the loan correctly in your corporate books. There are exceptions to the 1-year repayment limit. The Income Tax Act allows longer repayment terms when the loan is used to purchase a home for personal use, shares of the corporation, a car used for work purposes, or items directly from the business via trade debt. However, these must be legitimate purchases, not just excuses to access company funds. For a shareholder loan to remain tax-free, it must be issued in the ordinary course of business with a clear business purpose. You should make regular repayments, and ideally, the company should offer similar loan terms to other employees or shareholders to avoid IRS scrutiny. The IRS often audits returns that show shareholder loans to determine if they're disguised wages or dividends. They investigate your relationship to the organization and the details of the loan. If you're the only shareholder and completely control your earnings, the IRS may be more skeptical about the validity of your loan. The more businesslike your loan appears, the less likely the IRS will question it. They check if you signed a formal promissory note, pledged security against the loan, are paying interest, set a repayment schedule, have missed any repayments, and if your company has tried to collect any overdue funds. Several situations raise red flags with the IRS. These include loans with no documentation, no repayment history, below market interest rates, loans offered only to majority owners, and loans written off as bad debt. If the IRS determines your loan isn't genuine, they can reclassify it as a distribution or dividend, making it non-deductible for your corporation. To avoid penalties, document the withdrawal as a loan with a promissory note. Set interest at the federal rate. Provide collateral if necessary. Record the transaction properly and repay according to the terms in the promissory note. Best practices for structuring a shareholder loan include drafting a formal agreement outlining the amount, interest rate, repayment terms, and collateral. Charge an interest rate at or above the IRS minimum. Establish a regular repayment plan. Avoid rolling over loans indefinitely. Ensure proper recording in financial statements. And use loans for business purposes when possible. Remember that borrowing from your company can be a useful financial strategy when done correctly. However, it requires careful planning, proper documentation, and strict adherence to IRS rules. When in doubt, consult with a tax professional or business attorney to ensure your shareholder loan won't create unexpected tax liabilities or trigger an audit.